everyone. Call to order the Ad Hoc Committee on Premises Alcohol Liability. We're here, we've taken testimony and heard information on 5066. Today we're going to have a committee discussion with that. The bill, we're considering today is a direct result of the complex and important discussions we've had during the Ad Hoc Committee meetings. I'm going to have an amendment that we're going to pass out, and so we'll talk about that at first. Are we ready to pass that out?
I've got it.
Okay, so thank you. So you all have that. In 2017, Act 45 was signed into law, which maintained that any establishment selling alcohol for on-premises consumption after 5 p.m. was required to have a liquor liability policy of at least $1 million in coverage. The Department of Insurance reported last month that insurance companies in South Carolina are spending almost $3 on claims and expenses for every dollar they collect in premiums, which I think by any stretch of imagination, that math doesn't work. This has led many insurance companies to significantly raise insurance rates on their customers, while other insurance companies have chosen to get out of the market altogether in South Carolina. Responsible business owners have seen the cost of their insurance premiums rise significantly despite never having a claim filed against them. Some small business owners have permanently closed their doors because they can't afford the increase in premiums. What this bill and this amendment seeks to do is to provide immediate relief in those premiums in two ways. First, the bill, as we're going to be proposed to amend, provides incentives for businesses who carry this type of insurance to mitigate the risk associated with on-premises consumption of alcohol. This can be done in a combination of ways. An establishment that stops selling alcohol would be able to reduce their insurance coverage by $100,000. In that instance, the coverage would be $900,000 if they stopped serving alcohol by midnight. There would be additional drops in coverage for each hour that the establishment stopped selling alcohol. For example, an establishment that stopped serving alcohol at 6 p.m. would only need $300,000 in coverage. The bill, as we propose to amend, contains an alcohol server training program in businesses that, if the business requires their employees to complete the training, the establishment would get another $100,000 reduction in their coverage. Same would apply for the $100,000 reduction in coverage if less than 40% of the business's sales was based on alcohol. Tax-exempt nonprofits and single-event permit holders would be required to have $500,000 in coverage as opposed to $1 million. A business can take advantage of some or all of these mitigation factors, but under the bill, as we're going to propose to amend, would maintain that the businesses would have to have at least $250,000 in coverage. So if they take advantage of all the mitigation factors, it would go from what the $1 million now, possibly down, but no less than $250,000. The bill also requires private insurance companies to establish liquor liability mitigation measures and offer premium discounts to businesses that comply with those mitigation measures. This is similar to how we handle homeowners policies within our state code. The second way this bill helps to ease the stress on the insurance market is to create a program within the Department of Insurance that provide access to liquor liability insurance coverage to those who choose to purchase policies from outside the traditional market. The Department of Insurance can contract with a private entity to administer the program, and the program will be overseen by an 11-member board of trustees, 3 appointed by the governor, 3 by the House, and 3 by the Senate. No member of the General Assembly would be able to serve on the board. The director of the Department of Insurance and the chief of SLED would also serve as ex officio directors. 2 funds would be created under the amendment within the Department of Treasury: the Fair Access to Insurance Fund and the Liquor Liability Victims Compensation Fund. Those funds will be required to administer the program. The Fair Access to Insurance Requirements Fund will be initially funded through a one-time loan from the Insurance Reserve Fund. The loan will be repaid by the Fair Access to Insurance Requirements Fund at an interest rate equal to the IRF's annual rate on return of investments to make the IRF whole in this process. Additionally, $5 million of the liquor by the drink tax would be remitted annually to the Liquor Liability Victims Compensation Fund. The annual contribution of $5 million will support the program and ensure funds that are available for victims' claims. This bill also ensures that the annual $5 million contribution from the liquor by the drink tax will sunset and will therefore not always be required. That would be timed with when the loan is repaid, that the $5 million contribution from the liquor by the drink tax would stop being put into the program. The bill also increases the assessments charged to persons convicted of driving under the influence, DUAC, and felony DUI by requiring an assessment for those convicted of those offenses of $88. This additional assessment will be distributed to the Liquor Liability Victims Compensation Fund to support the program and ensure funds are available for victims' claims. We also have a provision clarifying that captive insurance applies to liquor liability. Captive is when similar businesses groups band together to self-insure. While the law has been silent on that, this explicitly makes it clear that captives may engage in the business of liquor liability. So, members of the committee, that is the amendment. So it's a strike and insert. Discussion on the amendment. Yeah.
Mr. Chairman, just a couple comments and a couple questions for staff. Just want to make sure of it. But my understanding of this at the end of the day, just to break it down to its most simple components, is we're attempting to set up a fund to subsidize the risk, at least for the $1 million in coverage, in an effort to encourage insurers to participate in that market. And that's kind of part one of the bill. And we're putting funds that are raised from sources generated within the bill to fund that. Part two of the bill, I think in particular as it relates to our smaller businesses, and that's in Section 3, are the mitigation provisions that allow under certain circumstances businesses to be able to have less than the $1 million in coverage. The question I did have, and I think I'm right, but I just want to confirm, subsection E of Section 3, a person licensed or permitted to sell alcoholic beverages for an on-premise consumption, which remains open after 5 o'clock, may qualify for a liquor liability risk mitigation. Person qualifies if the person, and it sets out 4 categories as I see it. I just want to make sure those are each alternate categories. It's not, you don't have to comply with all 4 of them. It's any one of these 4.
You can comply with a combination of those. What it would do would be able to get you down, if you're an entity, you could get down from the $1 million requirement now down to no less than $250,000 of coverage. So you could again, for each hour that you close before midnight, you get a $100,000 reduction, and for each of the subsections, you would get a $100,000 reduction. Now, nonprofits and single event permittees would start at $500,000.
Another big benefit is, as I read it, and I want to make sure I'm right about this, with the nonprofit organizations, it's not just for single event events. It's for nonprofits and single event. So, I mean, to my understanding, and I hadn't done a lot of liquor licensing stuff in years, but a lot of the private clubs are nonprofits. Private clubs are often set up as nonprofits. So I think it would cover, I mean, that's a fairly large classification.
Yeah, it's a nonprofit which is exempt from taxation pursuant to 501c3 of the U.S. Code.
Certainly, some nonprofits could become 501c3 exempt if they're not already 501c3. So,
yeah.
Thank you. That's all I had.
Mr. Robbins.
Thank you, Mr. Chairman. So first, I'd like to thank staff for their hard work in preparing the initial bill and all of the many conversations and the amendments and discussing this very difficult issue. But I guess, Mr. Chairman, my first question would be, it appears from the letters we have received and the testimony that we've received from the industry that we're in a crisis situation right now. Is that fair to say?
from an objective standpoint, and especially if you're a business that's facing these exponential increases in premiums, it's a crisis.
And so also, as I understand it, the Department of Insurance is not able to address this issue directly. Is that also fair?
From the testimony we've heard and the discussions with the department, that'd be correct.
So we are basically being asked by the industry to step in and help.
Correct. And I think the mitigation factors that we put in for the private insurance that would allow licensees and permittees to avail themselves of what I call the step down in mandated coverage, along with the relatively immediate availability when this bill becomes law of the Department of Insurance to have a program through which insurance could be provided through this program that would be funded by the loan and the liquor by the drink tax. I think it would that should have an immediate impact in allowing those who are facing exorbitant rates to seek insurance through that fund.
And I agree with you. I think that those components of the bill are very good. My disdain, I guess, is that we've heard from the insurance director about the losses that the insurance carriers are claiming, but we don't have a whole lot of detail from them as to why that is, and we don't have any detail as to whether they are implementing any of these procedures that are outlined in this bill. And I certainly would prefer for the free market to handle this, but if they're not going to address it themselves, and I guess we have to, it's not the position I'd like to be in. And I understand from this amendment that the funding for this particular setup is strictly going to come from the excise tax. Is that right?
It would come from the initial one-time loan, and again, the insurance reserve fund would be made whole, but based upon the required interest rate that would be tied to what they're earning on their investments. And then you're correct, Representative Robbins, that the funding necessary, if it's needed, well, first of all, the $5 million that's going to be coming a year through the loan period would be from the liquor by the drink excise tax.
Right.
In addition to the assessments that we're putting on DUI, DUAC, and felony DUI convictions. Also, you're correct that the funding that's collected from the excise tax would be the only taxpayer funding that would go to that. So it would be borne by the folks who are consuming alcohol.
Right.
Yeah, and not coming from the general fund.
And I think that's a very important point, because I've heard from people about that issue. So I'm pleased to hear that the general fund is not going to be accessed. Do we have any idea what the initial loan amount will be, or will that be set by the board?
It would be set by the board in consultation with the Department of Insurance, depending on the factors they're going to set up and make it actuarially sound. I think that the insurance reserve fund could handle up to $75 million. That would not have a negative impact on them, but I anticipate it would be less than that. I think we've learned that all liquor liability premiums in South Carolina total roughly $25 million a year. Mm-hmm. And so I don't, I think maybe have to plan on that, but I can't foresee a situation in when 100% of the market would be through this fund.
Gotcha. And then is there an anticipation that at some point in the future we won't need this program?
That would be that's the goal of this, is to stabilize the market, just like we've done and we've seen in other states that have done this, and we've seen with medical malpractice, JUA type situation. It's needed at first because you had a crisis situation. The market in that industry for insurance stabilized, and the private market was able to take back over. So that would be the goal. Yes, sir.
Thank you, sir. One final question, I think. Can you explain that sunset provision to me one more time?
The sunset provision would be that the $5 million would be transferred annually into the victims fund that would cease when the one-time loan repayment from the insurance reserve fund is paid in full.
Okay, gotcha.
So it would not be, so basically, it's a crisis point now. We're seeking to address it is the most immediate way we can. After that, after hopefully the market has, that insurance line has stabilized, that then the fund, the insurance offered through the Department of Insurance would be a market of last resort.
Okay. But we're not buttressing this new program through the general fund?
Correct.
Okay.
Yeah, it comes solely, well, from the loan, from the $5 million, from the liquor by the drink excise tax, and then any additional money that's needed from the liquor by the drink excise tax to make it actuarially sound. And the board would determine if that's needed.
Okay.
Well, you may never get to that, but if you do, right, any funding is coming solely from revenues already collected by the state that are coming from liquor by the drink tax. So
Okay.
you're not paying for anyone who buys a liquor drink in South Carolina would be the only one funding this transfer of funds.
And we're talking about on-premises consumption, right?
Yes, sir.
So it would be at a bar or at a restaurant?
Any place that a person in a licensed or permitted location that would buy a liquor by the drink, that's the only revenue that would go into this.
Not from a ABC store or grocery store or a place like that, right?
Correct. Just to not be technical, unless it's like a grocery store in my neighborhood that sells.
Well,
But not from.
There's a Lowe's in Somerville and has a bar in it.
Yeah, so that would be
Because heaven forbid we can't go grocery shopping without taking a drink. So they've got one in theirs. Yeah.
So that would be the only example I can, based on your question, I can think of where that would apply to a
Gotcha.
grocery store.
Thank you, Mr. Chairman.
King.
Thank you, Mr. Chair, and I'm happy that we are tackling this issue because I've gotten a lot of phone calls, but more of my phone calls have come from private clubs, VFWs, places like that. But do we have an example, if I was explaining to someone at the VFW, do we have an example of what they will realize in reference to rate if and when this is passed?
Well, we wouldn't be able to, no one can tell us now what the rates would go down to, but if you have less coverage and you're also engaging in mitigation efforts to reduce your risk, the goal of this would be to reduce premiums. So number one, if to start off with the nonprofit, if the VFW is a 501c3, then they would be able to avail themselves of the $500,000 minimum coverage as opposed to the $1 million. So that'd be cutting it in half. And if they avail themselves of the other mitigation factors in here, they could get down to $250,000 a year. And that would be aggregate, not per occurrence. And so the hope and the desire and the intention of this would be to result in lower premiums for all licensees who take advantage of this, but especially and including the nonprofits.
All right. Thank you.
Mr. Rose.
Yeah, and let me preface my comments, and I have a little microphone issue here, but let me ask, first, I know you've been working really hard on this, Mr. Chairman. You know, I've got some calls and texts from you over the weekends. I know you're working hard, and I appreciate your keeping everybody informed, and I know staff's worked very hard on this too. Help me with the aggregate is $1 million. So hypothetically, and help me understand, if someone pays out for an accident, someone's killed in January, and they pay out $1 million. If there is another incident that happens later that year, or another one has come about, I mean, the money's gone.
That the limits under that policy would be $1 million aggregate. So that the policy would cover no more than that.
Yeah.
For that in that time period.
Yeah, for that 1 year time period. I mean, what is your thoughts on that? I mean, or I guess because that's a deep concern that I have.
Well, the Department of Revenue has already made a finding through their regulatory authority that it's aggregate is based per occurrence. So well, it's current regulation. So we're codifying that in this, and I think we're making the policy decision that on an annual basis, that a licensee should be required to carry no more liability insurance than that would cover up to $1 million. And the resulting thing would be the step down in these mitigation factors that would further reduce that.
With the Department of Revenue, obviously that's an opinion, it's not binding.
Correct, and that's included. So,
Yeah, I
so
understand.
we're trying to codify that in this.
Yeah, I understand. Is that the way this has been in practice? Because it's my understanding it hasn't been practiced in this way as far as in the courts with it being an aggregate of $1 million.
The law that the General Assembly enacted in 2017 requiring the $1 million minimum coverage did not specify if it was aggregate or per occurrence, so that left some ambiguity. So this bill and this amendment seeks to provide clarity that it's aggregate, not per occurrence.
Okay. All right. Thank you.
If there are no other questions, I'd move for adoption of the amendment. All in favor, say aye. Any opposed? Okay. Thank you. We're on the bill as amended. We've discussed the bill. Any more discussion? Mr. Wheeler.
Just one quick question, just because we've all seen this come up during budget week from time to time. Have we run any of the funding requirements for this by our friends down the hall, or will there be any issue? I know it's not coming out of general fund revenue, but just so we don't have any nasty surprises later.
There will be discussions with that, and there have been discussions. You know, what I would say is that the requirements in all likelihood will be met through the loan for the first year, for the first couple of years, and the premiums that are coming in. So I wouldn't anticipate, there's no way to say with absolute certainty, and I don't want anyone to misunderstand this, but if you have a loan in the neighborhood of whatever they're going to loan it, it'd be below 75 million, but possibly in the multiple millions, and then you're adding the premiums to that, plus the 5 million and the money coming in from the assessments, the likelihood that the fund would need additional funds from the liquor by the drink is minimal during the first couple of years of the process.
And in no event are those funds to come out of the general fund, recurring revenues. It's
Correct.
Limited to these sources.
Correct. They were limited to these sources that are derived solely from those who consume alcohol by the drink.
And that's
and the assessments on the DUI, DUAC, and felony DUI.
And those are the only additional assessment is that $88 on
Correct.
the DUI.
The new assessment on DUI, DUAC, and felony DUI convictions would be $88.
Okay. And there is no new assessment on the liquor by the drink. That's just a portion of what's
no, sir.
already being charged.
Correct.
Thank you, Mr. Chairman.
Seeing no further questions, if staff will call the roll.
Representative Elliott?
Aye.
Representative Bailey?
Aye.
Representative King?
Aye.
Representative Moore? Representative Robbins?
Aye.
Representative Rose?
Aye.
Representative Wheeler?
Thank you. 6-0, it's passed out favorably. I want to thank everybody for your work on this, your hard work on this. It is a situation that all of us have heard from our constituents all across the state, and balancing the impact, the negative impact that drinking and DUI incidents have with the ability of businesses to do what they need to do to be economically viable. So I want to thank you all and thank staff particularly for working on this. And with that, we are adjourned, and this will most likely be the last time this committee meets unless that we reconsider this bill from action sent to us by the full committee. Yes, yeah, yeah.